Hello, my name is Dr. John McDermott. I am the Chief Investment Strategist at Symmetry Partners. Despite considerable evidence to the contrary, many investors believe that they can beat the market by engaging in stock picking or market timing trading. Unfortunately, the volatility in stock returns makes distinguishing between luck and true skill difficult, and this is especially true in the short term. Furthermore, active investing is expensive, both in time and dollars. Yet, active management is alive and well. Why? There are many avenues of reasoning to pursue this question. Certainly, an important consideration is the role and incentives of the financial services industry itself. Today, however, I will focus on the psychology of investors and well-known biases in decision-making, specifically overconfidence and self-serving attribution bias. Are you a better-than-average driver? Pose this question to a random group of drivers, and you will likely get back that the vast majority of drivers consider themselves to be above average in skill. In one published study, 82% of those surveyed. Obviously, this is not possible. All drivers cannot be above average. This is evidence of overconfidence, which has been found by researchers to be a prevalent bias, and especially true in the United States. Further, overconfidence is especially prevalent in males in male-dominated fields such as finance. There has been some very interesting research done by Brad Barber and Terence Odian on investor behavior and overconfidence. In a large study of household brokerage accounts in the 90s, they found that greater trading activity was related to increased risk-taking and poor investment performance. They also found that the portfolios of single men had the highest turnover, followed by married men, married women, and finally single women. They surmise that overconfidence is a potential explanation for the differences in trading and risk-taking. What then is the source of this overconfidence, and how does it relate to investing? Two sources of overconfidence are the illusion of knowledge and the illusion of control. We tend to be overconfident when we believe we have superior knowledge. The abundance of annual reports, market forecasts, experts on television and radio, our own financial advisor, advanced degrees, professional certifications, etc., all lead us to believe that knowledge is ours. Information, however, is not necessarily knowledge. The illusion of control can arise from the fact that we have choice. For example, we can now buy and sell stocks and mutual funds with great ease, perhaps even in an online trading account in our own living room. We can change financial advisors and firms. We can choose to take the advice of experts or not. The illusion of control also increases with the familiarity of the task. For example, subjects in psychology experiments tend to bet more aggressively as they become familiar with a gamble, even though the odds of the gamble remain unchanged. People tend to associate their successes with internal factors like their hard work, skill, and intelligence, while they tend to associate their failures with external factors like bad luck. The implication for investors is clear. When investors beat the market, they perhaps see this as validation of their efforts and even self-worth. However, when faced with poor performance, it is easy to find a scapegoat, like a financial crisis, or a negative event, such as product liability lawsuits or corruption in the upper management of a firm. While there are many reasons for the continued belief in active investing, behavioral biases can provide some insight. Investors tend to be overconfident in their abilities due to an illusion of knowledge and control. Further, investors are likely to attribute their successes to skill and failures to bad luck. Be wary of these biases and their impact on your investor behavior. Be humble and realistic, and keep your long-term investment goals in mind. Thank you for joining me today.